Hi, everyone. Welcome to the 118th episode of the Timing Research Show for December 27th, 2016. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be discussing the 170th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can download this or any of the past reports there. Matt Buckley is supposed to be hosting today, but he might be having some technical difficulties. So we're going to go ahead and get started here. We have Doc Severson of TheoTrade.com on the show. It's been a while since he's been on, so happy to have him back. So Doc, if you want to go ahead and tell everyone a little bit about yourself and what you're up to these days.
Sure will, David. Thank you. Again, my name is Doc Severson. I've been trading since the roaring 90s, and I was forced into becoming an options mentor at gunpoint in about 2005. So it's been about 11 years or so I've been doing this. So I've recently been going down the path of Whiz, getting my private pilot license. So this is tough to get hours at this time of year, but these are some of the things I'm doing in the morning when the market's not open. But overall, joining TheoTrade, TheoTrade started earlier on this year, and one thing led to another, and I joined up with our team in the late winter time, and it's absolutely been phenomenal so far. So I joined them as a contributor. We run a chat room 24/7 with about 5 live hours a day of live chat and video analysis, or sharing our screens and walking traders through what we're doing. So we have some pretty heavy hitters on the team, such as Don Kaufman, Jeff Bierman, Slim Miller, amongst others. So we do live options and futures trades and mix that with about 12 additional coaching sessions per week. So we have a very, very active and live chat room community. So later on, I'll tell you guys about a free event we're going to be doing tonight. Don Kaufman's doing a live free webinar tonight. So I'll give you guys a sign-up link for that later on. Back to you, David.
Okay, great. Thank you. And Andrew Keene of Alpha Shark. Good to have you back as well. Would you tell everyone a little bit about yourself? Andrew, I think you're on mute.
Are we good now?
Yeah, sounds good.
Okay, Andrew Keene, CEO, founder of AlphaShark.com. I was a trader as a market maker at the Chicago Board Options Exchange for over a decade. I've written 2 books and 3 ebooks on trading. We run one of the biggest all-day paid audio and visual trading rooms in the world. We have close to 400 subscribers that pay to watch me and my other moderators trade equity options throughout the course of the day. We have educational courses as well. Over the last 4 years, I've done 500 live webinars, and I've taught about 50,000 students how to trade. I'm not registered at all, so don't have any registrations. I just trade on my own account, but I predominantly focus on option activity in the equity option space.
Okay, great. Thank you. And Jim of Option Professor.
Sure. Option Professor is the firm that has educational materials on the different uses and risks of the option strategy, starting out with the basics for people who've never done options before. And then, of course, advancing into the option writing strategies like covered call writing and put writing. Also, two-sided trades like your strangles and your straddles. Ratio trades like ratio call spreads, and other transactions like hedging with collars and put hedges and things like that. So there is a lot to learn for investors out there, and obviously the more they know, the more of a menu of choices they have when they look at a circumstance. And the idea behind Option Professor is that you're educated on all the choices out there and try to pick the best one that would be for your circumstance. And I've been providing the content for them for well over 10 years.
Okay, great. So let's go to the report. I actually just noticed there's a typo. Question 1 should read, which direction do you think the S&P 500 index will move from this coming Tuesday's open, that's today, until Friday's close, December 27th through December 30th. And Doc, let's start with you. What do you think, or what do you think is going to happen this week?
David, I think we're gonna experience a slight persistent upside grind, and on very low volume this week, and actually as well next week too. And then I think all hell is going to break loose as we get into the second week of January. So for the next couple of weeks, I think very drifty, slight upside, persistent grind.
Okay. And what percentage would you estimate that you're correct?
Oh, I always estimate 100% correct, right, David?
All right. And Andrew, what do you think the S&P 500 is going to do this week?
Yeah, I was actually shocked and surprised to see the market actually sell off a little bit last week, and wasn't anything massive. But we did sell off, which was kind of surprising because we usually have the Santa Claus rally, and we really saw all the retail names getting hit pretty hard, and they get a little bit of bounce back today. I also think the market's going to go higher. I think we're going to grind into that in the year, which is really interesting. Is there's a January effect, and 80% of all years do what happens in January. And this year we had a massive downtrend in January, and the market went straight higher. So January will be very important, but I do think the market grinds higher into the end of the week. My conviction level is not very high because the volume is very, very low. I've barely traded much the last couple of days. So I'd say about 55%.
Okay, higher 55%. And Jim, what do you think for the week?
Well, right now it looks to me like it does want to grind higher, and the Dow Jones flirting with that 20,000 mark. It just seems like they want to push it up towards that level and get that 20,000 print maybe before the end of the year. And underneath, there's a little bit of a gap on the short-term graph on the S&P mini, somewhere around, I guess, 2265 or 2260. So if they can hold that area, they could grind a little bit higher, get that 20,000 print before, the New Year celebration. And then, like Doc was saying, after the first of the year, I've talked to, some fairly large investors, and they are talking in the terms of trying to do some selling after the first of the year. Maybe deferring some of that capital gains tax for another year. So it'll be interesting to see how things shake out after everyone comes back from the holiday. But right now, grinding a little bit higher, as long as we hold above that 2260, 2255 area, seems like the way to go. And confidence level will be about 60%.
Okay, great. And if you had a chance to take a look at the report yet, you can see that the survey responses were actually 63% or 62% said they think it's going higher for the week, but there was higher average confidence on the bearish side. So based on past results, my prediction is actually 55% chance lower for the week. So let's move on to question. Well, let's move on, and Doc, what else are you what other kind of events and things are you watching happen this week?
It's kind of interesting. Let me actually bring up, I'm going to do a quick screen share here.
Yeah, you're welcome to share your screen and
Okay.
chart or anything.
So basically what I'm seeing is I tend to use fractal timeframes here. And I've been watching this monthly pattern here for a long, long time and waiting to see which way this was going to break, because I felt that this has 500 points of potential on it. And so we've seen about half of that play out, and it's chosen its direction as the upside. The other thing that I do believe, and I've been watching these things for a long time, is that everybody is looking for this thing to just hurl. As soon as we get into the new year, just the majority of people that I talk to or experience or run into just think that the move is so overdone and we're just going to snap back to 1800. And I just don't think that's the case. I think what we are going to get into as we get into January is we will see more realized volatility, right? So looking on the weekly chart, I think we will get into a larger range of volatility. The first red candle that we see NBC is going to pull out Jim Cramer, put him on the Today Show to like try to calm everybody down. We'll see the first red candle. People are going to freak out. But I think it's just going to be an extended, more of an extended range as we get into some heavy consolidation. What the market is showing right now is it's moving into quiet and trending. So we're getting this kind of stair-stepping type of move right now. Now, the thing I am seeing is we're close to exhaustion here. So there's a limit to the linearity that this is going to run. So as we get into January, I expect to see more realized volatility. I expect to see the implied volatility actually may get off the floor for once, and we might be able to actually sell some options. Until that time, though, it's wise to be a buyer at these levels. So back to you, David.
Okay, great. Thank you, Doug. And Andrew, do you have anything else you want to share about what you're watching this week?
No, I mean, so I have a very unique style of trading. So what I look at is unusual option activity in the option market. So I watch institutional order flow across every single exchange to see, unusual option activity. So I am basically long, and I'm looking at my portfolio, about 8 different names. They're all call options. They're March to June. So I don't have any risk till January and February. If I'm long calls, I'm long delta, long gamma. If I'm long gamma, I'm short theta, which means I'm paying every single day for the time decay. So January and February, I don't really have that much going on. But I do think that we are going to move higher at the beginning of the year. More cash is going to be put. I do agree with Doc on, we're going to have one day where we'll probably have a huge reversal day where we'll go to new all-time highs, close on the lows, and then depending on how big the candle is and how much we close off the highs, people will start calling the top. It was interesting with Brixton and with Trump. Everybody thought Trump was going to be bad for the economy, and the futures were limit down when they thought he was going to win, and then he won, and then we've gone to new all-time highs. So I didn't see that coming at all. If someone would have told me that Trump was going to win, first of all, I would have said probably not a good chance. And then if you told me that Trump was going to win and the market was going to rally, I would have said you're nuts. So, I unfortunately haven't been long throughout this, election time period. But, I am long here until I see a lot of put activity or the VIX is under 12, spike a little bit here. I still think we grind higher.
Okay, thank you. And Jim, what are you watching this week?
Well, there's not too much going on as far as the news is concerned. You've got some petroleum news later in the week, and you got a couple of auctions from the Treasury. So there's not a whole lot going on as far as news is concerned. I think, basically a lot of people are trying to figure out, since we are fairly advanced away from the moving averages, we're in new high territory so much, basically a lot of people are strapped with the idea that it's too high to buy and too strong to sell. So that's why we're meandering here, I think, and working off some of this big excess. This sentiment change that we saw from the November election to now is about as big as I've ever seen in my entire career. The negative sentiment going into this election and the happy days are here again sentiment that's being played right now. So it's been a very wild change. I was wondering if any of you guys watched the RSI. And I was wondering if on the S&P, with all these new highs we've seen, has the RSI lagged behind the new high move? Do either of you guys follow that at all, or relative strength index? Andrew, no?
I only watch RSI on the bottoms. I don't watch RSI in the overbought zone.
Yeah.
Yeah, I look at RSI a little bit. I mean, it's not one of my key indicators.
No.
But, I was looking at it like an X for a reversal in X, and X did what I thought the market was going to do, which is make a new, short-term top and then reverse off that. So I do look at RSI, but I don't look at it too much. I don't think the market's extremely overbought here. Let me just pull the RSI and see where it is, because I think it's under.
I was just wondering, Andrew, if there was a relationship, because sometimes over the years I've noticed if you make a massive new high and then the RSI is lagging tremendously, the new high sometimes cannot sustain itself.
Yeah, but there's in the short term, anything in this world is just a supply-demand curve. So RSI can get out of whack, and if you try to start shorting it when it hits 70, which is overbought levels, it can go to 80, 85. Right now on the RSI, I'm looking at it about 67 on the daily chart. We got up to about 77, so we're getting close to that 70 level, which is technically considered overbought. But in the short term, I think we just continue to grind higher.
Yeah, it's just one thing of many things, that could be looked at. And one of many things that historically, if there's a real lag in the RSI with a market making a big low or a big high, it's sometimes a indicator to put into the soup that might be helpful to figure out what the next move is going to be.
If anything, I'll look at divergence on the top side.
Wait, that's what I'm talking about. Yeah, the divergence between the RSI and the price.
Well, no, I'll actually look for the RSI to make a lower high as the price makes a higher high. So a Class A divergence on the RSI 14 Wells Wilder, but that's about the only time. I mean, I maybe hold that thing out, once every 6 months.
Oh yeah, it's kind of a sidebar.
All right, sounds
So
good.
anyway, I mean, just getting back to what you're saying there, basically like everyone else, the volume seems pretty low. The market is quite strong lately, and that 20,000 number is kind of enticing to it. So grinding a little bit higher just seems to be the basic concept here.
Okay, and let's move on to question 4 for Doc. What is the most important financial lesson you learned during 2016, and what do you hope to learn more about in 2017? Or for you guys, if you want to talk about, with your students and your subscribers, if you think there's something in particular that you've noticed that they most need to learn. You can talk about that as well, possible. So, Doc, to you.
Let me pull out the screen again because all right, here we go. So what I tend to find is that people, forget about what's on the screen here, but what I see guys do is that they spend time to learn about some kind of new strategy. And they'll trade it a couple of times, and if they don't win the first couple of times, there's some other bright, shiny penny that's over here, and they go thundering in a herd over to here, right? And so they'll learn about this, they'll buy some other program, learn a couple of times, trade a couple of times, probably don't make a profit on those couple of trades, and so they get discouraged, and there's some other bright, shiny penny that's over here, so they go thundering over to here. So this is what I see people do, is they just go perpetually in this big cycle. They end up being a jack of all trades and really a master of none. So really kind of the mantra that I've been sharing lately is find your thing, find your one thing, kind of like the Curly's Law from City Slickers. Find the one thing that really makes sense to you and own it. Find a way to own it in this market. And all you have to do is just not quit and keep looking for the root cause and why it's doing that. So, I mean, this is the thing that I keep coming back to again and again, David, is that, look, trading, there's nothing really new in what we do. The markets are always new, and markets are always going to be giving us a different clue about what's going on. But trading itself doesn't really change that much from year to year. And it's a question of whether or not we're going to stop and find out what works for us. Because again, at the end of the day, it's not really you trading versus the market. It's you trading versus you. So find it, in 2017, I would say to people, find your one thing, find what works for you and master it. And don't become don't keep chasing your tail around like this.
Sounds good. And what are your thoughts on paper trading?
Paper trading by itself, I think paper trading is useful to find out the mechanics of the trade, because I hate seeing people lose money because they don't know how to open or shut down a trade. Especially a complex multi-legged trade. They don't. So learn the mechanics on paper. And the second thing that you need to do is learn how to build a system on paper first. And this is where a lot of people lose patience, because everybody says, no, you can't do a single thing on paper. But paper will allow you to, or paper money, whatever you want to do it on, will allow you to kind of get into a groove and build confidence, so that when you do go to one live contract or whatever else it is, right, earn the right to trade bigger position size. So I think paper can be useful at the beginning stages. Of course, there's limited functionality after that, though.
Yeah, I think Doc made a good point there, and they basically call it hypothetical results. So basically, the paper trading can be helpful if you're trying to establish a system or you're trying to establish a methodology, and you don't want to run through a whole bunch of money while you're doing it.
Mm-hmm. Okay. And Andrew, what kind of lessons have you learned or taught in 2006?
Yeah, I mean, the biggest one was at the beginning of the year, I just got cremated trading. I lost about $270,000 trading in the first 2 months, and I got back probably about 170,000 of it over the last 10 months, but it's been a grind to get it back. So I think two things is, one, can't always be one direction. So like sometimes I like to long puts in certain names based on unusual option activity. We saw some AIG February puts being bought today. I didn't put them on, but not being so levered in one side. And the other one is like going back to the basics of kind of, basically stick to a trading plan. I've tweaked my trading plan. I'm trading a lot smaller. I might have, 10 names on. I might have like $3,000 of risk on each name. So just kind of, scaling back. And, my goal is not to make the most amount of trades possible. It's to make the most amount of money possible. So today, I took a trade in Yelp as a day trade. And then besides that, besides my Yelp trade, I've only traded like 25 options. And on a busy day, I can trade 1,000 to 2,000. So just, when there's not good opportunities, scale it back a little bit, cut back on a little bit of risk. I could sit here for 4, 5, 6, 8 hours and not make a trade. And in terms of paper trading, I think paper trading is great. I always say, we had a joke in the office who said, you want to learn how to trade, light $100,000 on fire. And unfortunately, that's how most people do it. But paper trading, I think, is great because, it's not sexy. It's not fun. It's hard to get motivated to paper trade because you don't see the money at the end of the day. But I think it's great for, someone who's learning. I traded on a simulated account. I was trading corn and soybeans on the 5-minute bar using the Ichimoku cloud. It wasn't profitable. So then I didn't trade it. I didn't lose any money then. So I think the paper trading is great for beginner traders.
Yeah, Andrew, I was going to ask you a question on, when you're following the large blocks of trades on the options, you're obviously trying to get involved in the momentum of what's going on in a particular situation, right? Because obviously, as the volume and the activity is expanding, you're getting the idea that money's coming in. But is there any type of thing you look at that might be kind of trying to go and think like a market maker, meaning that's one thing that I thought was very big this year in 2016 is the contrarians, did pretty good if they started thinking like a market maker, meaning if everyone is selling like before the election, somebody's taking in all that action. And, if the people taking in the action seem to be more market makers than anything else, that might be the side to consider because the market maker may be dropping the price, knowing that that volume may dry up at some point or hoping it will, and then knowing that after the volume dries up, it'll snap the other way. And similarly to where we are now, there's obviously a lot of short covering that's gone on, a lot of people putting portfolios on at the end of the year, a lot of buying coming in, and obviously somebody's fading all this volume. So, what's your thought about, if everyone is taking one side, maybe the other side is interesting?
Well, I mean, when I watch, unusual option activity in the option market, there's no such thing as a short hedge fund. You can have a short biased hedge fund. So for the most part, everybody's long the market. So we see a lot more bullish activity than when you see bearish activity. And that's always going to be the history. If you pull up any stock right now, the call to put ratio is going to be so much higher on the call side. I'm thinking, a lot of times now, if we see, these upside calls being bought, we saw Coca-Cola May 43s, I never know a trader's stock position against their options. So I don't know if they're shorting stock delta neutral, shorting stock 1-to-1, are they buying a speculation? So it's kind of like a game to play this unusual option activity because you never know a trader's stock position. And that's why I say trading futures or Forex is like playing the computer in chess. And you're never, ever going to beat the computer in chess. Like, it's impossible. But trading unusual option activity is like playing like Texas Hold'em where there's a bluffing mechanism involved. So, I'm just watching this activity all the time. Like I said, and you make a good point of like, market maker strategies. I think a lot of this upside call activity that we see 4 to 6 months out, they're just buying calls because if an institution buys calls, they buy deltas, they buy gamma. They're also buying vega, so they're buying implied volatility. And maybe they're shorting stock delta neutral because in the last 12 trading days, the S&P has moved 30 points. We're not going to sit here. I mean, whatever happens next year, if we rally or we sell off, I guarantee we're not going to be closing at 22.65 in the futures. So maybe it's just a gamma play against it, but you make a good point on that.
Yeah.
All right. And Jim, did you have any other lessons that you learned or taught in 2016 you want to talk about?
Well, again, the concept of, being aware that just because everyone's doing something may not be the greatest idea to doing it. And also when things get very, very dead and the premiums are very dead, rather than trying to figure out one side or the other, maybe it's the time to do the strangles or the straddles or two-sided trades and take advantage of the low volatility, and then go out and get a bunch of time, and then let the smart guys figure out which way it's going to go, knowing fully well you might have a loser on one side, but if it explodes like it just did here in the last 2 months, you're going to be cashing a very big ticket on the other side. So with the implied volatility, and I'll talk about that in a couple of minutes, on a few of the different markets out there, one of the more interesting things to me is the concept of the two-sided trade.
Oh, okay. Sounds good. And okay, now Matt's favorite part of the show. Too bad he's not here today, but yeah, if you guys have any kind of trade idea or suggestion or that you'd like to share with the audience, or even just talk about a recent trade you put on that you think would be interesting to share. Doc, let's start with you.
Okay, all right. What I'm looking at here, when you asked us what we thought the market was going to be doing into the end of the week or so, I'm kind of pulling that into the first week of January, because I think we're just going to drift into the first week of January. So what I'm looking to do is, and I know this is one of Andrew's favorite trades here, is to do an expected move butterfly. So I'm going to set up a call butterfly at the expected move target, which is the current price plus the expected move into, in this case, 6 January. And that's going to run, in this case, about 36, 37 bucks per contract. So this is a very low cost trade. And even though it's at expiration, it's a low probability trade. It's maybe about a 20% probability. Realized probability on that's actually much better. So if we just get anything of an expected move, whether it's up or down, you can see that it will drift into the profitability range of this. So that's what I'm looking at, is this, in this case, it's a 27.5, 229.5, 231.5, 6 Jan call butterfly for cheap. So that's my thought for this week, David.
Okay, thank you. And Andrew, do you have anything you'd like to share?
Yeah, I think Doc's going to some of my webinars. No, that is, I love butterflies on measure move targets, because, not only are the market makers telling you and the implication of how much the market's going to move between now and any time period. And basically the way the strategy works is you just add up the at the money straddle. So you add the price of the calls to the price of the puts. And we could even I could just look at it real quick for this week. So for this week would be, market's at 22.70 in the futures, and the calls are 8.50, the puts are 7.50. So they're implying the futures are going to move either up or down 16 points by the end of the week. So you gauge a trade, like a butterfly, around the move of 22.85 to the upside and 22.55 to the downside. So butterflies are one of my favorite trades. We do a lot of them for earnings. Butterflies on measure move targets. Unusual option activity. I like FEYE. It's a cybersecurity name. We've seen huge activity on the March 15 lines. They paid like $1.30 for those. They're down to about 55 cents here. I have added, it is a losing position, so not everything I'm going to take is going to be a winning position. But FEY is one I have an eye on. I'm long some Gilead, May 85 calls, some FTNT. We've seen a lot of bullish activity in FTNT. That's another cybersecurity name that's always possible takeover. We've seen tons of activity in January, tons of activity in March. So I would say keep an eye on FEYE, FTNT. The charts aren't the greatest thing in the world, and Gilead, but we've seen a lot of bullish activity.
Okay, and Jim, do you have a trade you want to?
Yeah, well, with Option Professor, we're not doing actual trades. It's strictly education on the uses and risks of all the different strategies. But just an opinion going out till next year. The volatility measurements seem to be getting kind of low. On the stock market, the VIX broke underneath 11 for the first time since 2015 summer. And it was followed by a very precipitous drop and a very big spike in the VIX in late 2015. On some of the commodities, the gold VIX is around 14 area, and the soy is around 15. So the volatility has really come out of the market. And, we're going to be with Trump. Most people play show and tell. And obviously, Trump is playing tell. And now we have to see show. And so we'll be seeing show, obviously, as the year progresses. And the other two words that come to my mind is fuzzy math. Will Trump be, having accurate numbers applied to his accomplishments, or is it going to be fuzzy math? And so I think that's going to possibly cause significant volatility. So if you're going to have significant volatility, the strangle type position or straddle type position is interesting to investigate. Gold's in a range, let's say 1050 to 1300 in 2017. Maybe that range wouldn't hold. Soybeans are in a range of about 11 and 9, maybe in 2017 with South America and in the U.S. crops and the value of the dollar and other factors, maybe that won't hold. S&P's 2300, 2200, maybe this year, that range won't hold. And so investigating the strangle tactic, knowing fully well that if it does hold and it goes sideways, you can lose on both sides. But if you get a substantial move up or down, the one that you do hit on could be a pretty good deal. And then, of course, the other thing people might investigate is the concept of hedging. We've had a couple of sectors here go wild on the upside, particularly ones that are in the Russell. And, it would include the banks, and it would include the oils, and it would include, some of the other sectors that have had a pretty big move. And strategies such as collars or put hedges, might not be the worst thing to investigate if you have large gains in it and don't really know exactly what you want to do. An alternative to just sitting there and doing nothing might be to do something proactive as a hedge. So, these are some of the things going into this year that I find kind of interesting, and people may want to investigate to see if they think there's any value there.
Okay, sounds good. And all right, well, let's go through and have a closing statement from everyone. So, Doc, do you have any anything else you want to say about your site or what you guys have going on, or how people can get a hold of you?
Yeah, sure, David. I think we got a lot of echo here. Okay, I think we took care of it. Thank you. Yeah, once again, I am one of the contributors at theotrade.com. And what I'd like to encourage everybody is, apart from just checking out the site at theotrade.com, is to go to theotrade.com/consistent, because Don Kaufman's giving a webinar tonight on what he's calling, let's see here, it's how you can build a trade that is successful over many occurrences, how you can take minimal risk, how you can take high probability directional positions, how you can use proper risk and reward, and how you can trade without having to continually monitor your positions, such as fire and forget, right? So that's tonight. It's a 1 hour long. It's free. So go to theotrade.com/consistent. So again, my name is Doc Severson. I'll be there through the end of the year. We're on every single day. Back to you, David.
All right. Thanks, Doc. Great to have you on the show again. Okay, Andrew?
My email address is Andrew, ANDREW, @alphashark.com. Like I said, we run one of the biggest all-day audio and visual trading rooms in the world. It goes from 8 a.m. to 3 p.m. So 7 hours of all audio and visual. We also run a futures room that we just launched. I am not in the futures room because I do not trade futures. But if anybody has any questions about unusual option activity, about any products we have close to 30 SKUs. We have indicators, we have courses, we have new alert services. We just launched a day trading option alert service, a swing trading, and a longer term swing trading service. So if anybody has any questions whatsoever, feel free to reach out to me or ask any questions about what unusual option is and unusual option activity is or how to trade it. It's Andrew, Andrew at alphashark.com.
Okay. And Jim?
Okay, well, optionprofessor.com obviously has the 7 educational DVDs, which I think are very, very helpful to add to your and add value to your educational process if you're out there trying to find out more about options, because you want to understand the uses and the risks of these tactics before you start putting them on, obviously, and find out what's appropriate for you and what's not. The two things into 2017, as we're entering 2017, the two things that hit me is the word overbought. Because the moving averages on a 200-day basis on some of the stock indexes like the S&P is way down at 2131. On the Dow, it's at 18,247. On the Russell, it's down at 1202. These markets are trading substantially higher than their moving averages, which is one of the reasons that we're in this stalled out range. You're working off the excess of the volatility. And now going into the new year, the question is are we going to get that next leg up? Or is this thing going to pull back a little closer to these moving averages? And since obviously nobody knows the answer to that, it might be time to look at some hedging tactics. And collars and put hedges are two of them that people sometimes investigate. The second thing that I'm looking at is the volatility being substantially lower in the commodity sector, including grains and metals, and also the put options and the VIX being so low on stocks. That could create some kind of an opportunity for people who get long volatility and then give themselves a reasonable amount of time to see volatility hit. As news and events come out, obviously people will start moving these markets one way or the other. So at Option Professor, you have 7 DVDs to learn all the different strategies and find out what they're all about. And for those who want to investigate that, optionprofessor.com would be the way to go.
All right. Thanks, guys. And for everyone watching, be sure to hit the YouTube subscribe button to get updates on future shows. Also, you can go to TimingResearch.com to download any of the past reports or watch any of the past shows there. Also, be sure to join us next week. Anka Metcalf, James Ramelli, and Rob Hanna will be on. And so just want to thank my guests again for this week. Doc Severson of TheoTrade.com, Andrew Keene of AlphaShark.com, Jim Kenney of OptionProfessor.com, and Matt Buckley of TopGunOptions.com was supposed to be on today, but he wasn't able to join us, so he will be on their show in the future. All right, thanks everyone.
Thank you, David.